Everybody, we're going to get started here in just a minute or two. I'm going to kind of let some folks join here and then we'll get started. So uh, hold on for just another minute or so. Thanks for jumping on. All right, looks like we got a good group here on the webinar. We're gonna kind of just go through a few slides and we'll be looking at a test account as we go through here. But the big idea is just kind of hopefully answering some of the questions that folks run into along the way and kind of thinking about um, different ways that we've handled it as we prepare impact reports. So that's kind of the idea here. Um, we've, at least over the last couple months, had conversations with clients that are working on models and so forth. And, um, you know, with those conversations, kind of looking at the project, working with them, just kind of seeing some common things that I thought would be useful to kind of put into this webinar. So with that, I think I'll go ahead and get started now. My name is Paul Scheuren. I'm an economist with Impact Data Source. We're going to be talking about performing an impact analysis like an economist, um, primarily through the lens of how folks are using our software impact dashboard. And most of the folks on here are using our software, but a lot of this could apply to other circumstances for economic developers, primarily again for economic development. Um, so let's go through here. We've got just kind of the basic thing that we look at when we think about where we're heading with an impact analysis. The big picture, we want to understand what are the economic impacts? How does that drive additional revenues or costs, which essentially are those fiscal impacts? And then typically in economic development, we're trying to think about some sort of incentive. So those are the kind of the key points or where we're going with analyses in Impact Dashboard, and that kind of keeping that in mind is helpful um, as we kind of work through this process of preparing the analysis. So the agenda for today, we're going to touch on kind of as I count it anyway, about four key topics. So the first one is just the data collection and review process. We're gonna look at how people are collecting the information or putting it into Impact Dashboard. I want to encourage you to be active while reviewing that information and think forward to as you're, let's say, presenting this to City Council or your board, be able to defend the input. So if someone starts asking questions about, why, that number seems high or that number seems low, be able to kind of have an answer, so to speak, and have looked into some of those things. We're going to walk through the key project inputs and kind of just, I'll kind of, just go through the typical things that I see that are sometimes confused there. We'll probably spend a good bit of time on this idea of kind of fine-tuning the capital investment to taxable value assumptions, and think about some of the ways that you can kind of try to drill down on those things and just feel better about the assumptions that you're using. So again, you're able to defend the analysis you're putting together. And then the final The final step is this thinking about the main drivers of the net benefits and kind of once we have the results, be able to think through the assumptions that led us to those outputs, right? So if we have a lot of property tax, if the entire net benefit is being driven by property tax, um, what were the assumptions and what were the inputs that got us to that amount of property tax? So those will be some of the things we kind of just look at in an example here too. So first thing, again, kind of around this idea of data collection and kind of the biggest issues that I see. So there's kind of three methods that I see as kind of the typical way that our clients get information about projects. The first one is using actually using the integrated impact dashboard data form. Um, we built that data form to help economic developers collect kind of those qualitative and quantitative numbers that we need for the impact analysis. So for our purposes, we're really more so interested in those quantitative numbers, like what's the capital investment, how many jobs will you be adding each year, all of those things. But we layered in some of those additional qualitative things that, number one, economic developers are interested in kind of being able to collect, but they can also give you more context to understand the project than if we just had a bunch of tables and numbers and so to speak. So the biggest issue that I see, even still as clients are or prospects are filling out that data form, is maybe a misinterpretation of a particular input. For example, like taxable sales. So if you're asking for the prospect, will you have any taxable sales? If they're a retailer, well, they might very well know that number and be able to plug that in, and that's probably a good input. But for some projects, it probably wouldn't be relevant. So if it's an office project and this is the back office operations of some insurance company, they probably don't have taxable sales. And so if they put a number in there, that they might just be misunderstanding that and thinking you're asking for their gross revenues or something like that. Um, and the other thing that can you know, cause a problem, so to speak, or just not a problem necessarily, but a point where you might have to go back and follow up with the prospect is the lack of supporting details. So you have this ability with the data form to either kind of ask for some of these extra things, or you can disable certain fields that you don't want to, ask the prospect. But it can be helpful if they can provide and a narrative about their project or provide, an additional uploads and documents that they can attach to it. So if they don't provide that, that's one of the spots where you're just left with, again, some numbers and tables, and it's a little difficult in those cases to understand exactly what the prospect is trying to tell you. The other kind of major method of data collection that we see is when you are using your organization's ED application. So a lot of our clients still have their own either Word document or PDF document that they use to collect information, and maybe it's like their incentive application or something like that. And so those a lot of times they're kind of locked in because this is the way that we've done it, and we had this version of the application approved, and so that's the one that we're going to use. Um, and that's perfectly fine. A lot of times that has the information that you need, for your purposes. Sometimes it's missing inputs that are relevant to the impact analysis. So there can be times where certain information is either excluded or not collected in the amount of detail that we might want to collect if your first purpose was to kind of get this information for the impact analysis. The other thing that we see, so not even if it's just missing inputs, it might be things like aggregated values. So sometimes when we see those data forms filled out or those applications filled out, they'll say our total capital investment is $20 million, and it's not clear, how much of that might be for materials, or excuse me, how much of that might be for buildings, or equipment, or maybe they're, including how much they spent to purchase the land. And so from their perspective, total CapEx means one number, and then we might be interested in understanding how that breaks out. The other one that I see, it's just so frustrating sometimes, would be around the number of jobs. And so like maybe for part of the application, it's clear that this company is, an existing business planning an expansion, and then they tell you the job number, and you're scratching your head as to, well, is that how many workers they have right now? And then they're going to add some more, and it's just not clear. And so that's again one of the, I guess, issues I see around some of these ED applications that don't take into account some of the different things that can come up between like a BRE project versus a brand new project. Um, the other one that I see sometimes when folks are, at least maybe trying to do a preliminary analysis would be like a request for incentives. So you get like a pitch deck or something from maybe it's getting handed down from the state or something, but it's usually that document. Maybe it's prepared by the company itself, but at those kind of higher levels, when it's, let's say it's a big project like that. Um, it's probably being, put together, by some tax consultant that's trying to help the company find the best location and all of that. Um, and so what I find with that, sometimes those RFI documents just aren't very detailed in terms of the types of information you might want to have on hand to be able to run an analysis. So sometimes, as I say, it's inflated or generalized information from the consultants who are trying not to commit to anything, with a preliminary document, let's say. So, they'll give you a range. It's like, oh, we're going to hire 100 to 200 employees over the next 20 years. And it's like, well, I've got a set of inputs here and I'm trying to put in a number. What should I use? And that those are things that come into play. The other one that I see all the time would be if they tell you that they're going to generate that this project's going to generate X million dollars of sales tax revenue. And again, from that perspective, if you get in that position, if you put yourself in their position, they're thinking of the total amount of sales tax they might pay as a company. And so if we're talking about Texas, that might include the 6.25% that goes to the state and the 2% that stays local potentially. And so when they start telling you some of those big numbers, you might have to do a little bit of parsing to try to understand, that's great, good for the state, but most of that revenue is going to the state, for example, maybe with sales taxes. The other thing they might talk about property taxes. Again, we know property tax bills are getting split up and maybe the school district is going to get most of that money. And so as the city, if they're trying to tell you some of these endpoints, you just need to keep that in mind of their perspective there. So those are some of the things as you're collecting information or receiving information in the case of the RFI. You just want to be kind of keep top of mind as you're thinking about it. Um, again, through working with clients when they call with a question and maybe they have a question that's kind of unrelated, but then we'll kind of dig into the analysis. I want to encourage folks to actively and critically review the input. So if you get a data sheet that gets submitted, I want you to take a look at that and um, really try to wrap your head around what they've submitted, um, maybe even before, creating the scenario. So um, as I say here, it's tempting to click create scenario and just get a report. But this is kind of the most important step of the whole process is to really understand what they've told you and kind of maybe connect that back to reality before you start, wondering why the report looks wrong, right? Um, so um, a lot of times when I'm working with a client, I really might just only see the data sheet, right? So I might only see the incentive application that the company filled out, or the impact dashboard data form. I can see what I can see there, but what I find is usually as an economic developer, you've had maybe conversations with this company, and there's been a little bit more of a history, and so you have a little bit more background and context, and so it really helps the full picture kind of come together when you are reviewing those inputs and you have that context of everything you know about the project. It can help you kind of identify things that maybe just stand out as inconsistent with what you were expecting maybe before they submitted information. So this is an example like you know this is kind of a real example from a few weeks ago. This was a flour manufacturer that put on their data sheet $50 million in annual taxable sales. And this was in Texas, and for a lot of reasons, a flour manufacturer is not going to be uh, subject to sales tax with their product or with their sales. So um, they they were not familiar. Well, in that case, they were not familiar with taxation in the United States in a lot of cases, and so they certainly weren't familiar with Texas. And so we needed a little bit of explanation, but either you can have that discussion and explain to them that the 50 million isn't like really taxable sales, or what's easier normally is to just kind of make the adjustment in your analysis because you can be certain that in this case you could be certain that that was not going to generate sales taxes for the city and it would have overinflated or would have inflated the results, and you don't want to do that. Um, the other thing, as I've kind of touched on, is this: you want to be able to look at the inputs and understand, you know, are the inputs internally consistent? So a lot of times, again, this comes in when maybe we get a data form completed. It's that ED corporation's um, incentive application, and maybe it's been written in hand, right? So they're writing in pen on the data form, and maybe somewhere they tell us that there's a capital investment of $10 million. And then in another area, they give us detail and they say, well, we're going to build a $2 million building and invest 500,000 in equipment. And so you start looking at that and you say, well, what are we missing? If they're claiming 10 million in one spot, but they're telling us completely, inconsistent numbers somewhere else, are there additional investments they're expecting later, or where are they getting the 10 million investment from? So some of those things, as you see it in usually those kind of handwritten ones, you can kind of identify some inconsistencies, and you might want to just kind of mark that down for something to follow up with. Um, Another one would be kind of if they're telling you in one case that they're building a 10,000 square foot building and it's going to require an investment of $10 million, you might, you can do the math there and say, well, that's $1,000 per square foot. That's going to be a pretty fancy building. What are we missing here in terms of what we know about this project or what they're trying to tell us? So it seems like one of the parameters might be off there. Can we drill down on that? And so, and like I say, kind of being able to put all of these pieces together and kind of look at them critically, do just little small metrics here just to say $10 million, 10,000 square foot building. That's a lot per square foot. That doesn't seem realistic. What can we find out about that? Um, so this is usually when we're doing studies or for clients, or if I'm helping someone do a study, we usually come up with a list of questions to follow up with the prospect and maybe just confirm what we're doing. So I'm suggesting here, keep a short list of questions to review and confirm with the company. So you've reviewed the data form and you've identified a couple things that you can't quite explain, and you just want to make sure that you understand it correctly. And so, whether you put that, separately somewhere else, maybe you save it somewhere else, you can use the internal notes section of Impact Dashboard to kind of keep track of things. And so that might be helpful too if someone opens up the scenario later and you say, you can explain, what the prospect initially put in the data form and then what you adjusted it to and why you did that. That internal notes section can be helpful to kind of trace back some of those things. Um, as I mentioned, so sometimes the inputs will not seem right, but you follow up and maybe you learn, hey, this is actually a unique situation. They're going to run all of their taxable sales through the warehouse, and so that you wouldn't normally have sales taxes maybe for a particular project, but in this case, it's legitimate. And so when it's one of these big things, like I say about sales taxes, for example, um, you know if it's a big number, and what I find anyway is if it's a significant amount of sales tax, they're going to be able to defend or kind of explain why that is an accurate number. And they'll probably tell you a couple times like, hey, this is going to be a lot of sales tax for you. We're going to have X amount of taxable sales, right? So they'll usually what I find prospects when it is a legitimate number are ready to kind of give you more detail on it. So maybe they provide backup from their tax attorney or finance department that kind of explains what they do, why it's taxable, and that sort of thing. The other thing that comes into play, maybe they have another facility in the state, maybe it's in a different city, but they can give you, their sales tax returns for that other location, and you see, oh wow, they really do have a lot of, whatever it is, taxable sales. Um, and so that, you can sometimes by kind of going back to them with some questions, you know, just get an answer to, okay, that didn't look right off at the first step, but they've confirmed it for us so we can feel confident, leaving that in the analysis. Um, as I mentioned, identifying these inconsistencies may lead to the rest of the story. So if you don't have the full backstory on everything, or maybe it's just a unique project, unique company, by kind of bringing up some of the things that just jump out that seem either inconsistent or surprising for a particular type of project, it can help you kind of really understand what the company is doing and how it's unique. Um, okay, so I've got a couple hot takes on data collection and review. The first one is that you want to do an analysis and not data entry. So you really need to be proactive and think about these inputs critically. And we're not just typing in numbers, right? We can just type in numbers all day long or just click create a scenario. That's not necessarily going to help you all the time. We want to remember that we're doing an analysis and not just entering those numbers. The other one, we always remember garbage in, garbage out. And so don't be the trash man. If you like Always Sunny, I hope you appreciate the trash man. But it's so true with a lot of things, and it's particularly true in Impact Dashboard. If you put in bad metrics about what the company is planning to do, you're not going to get a useful analysis. And so we want to make sure we're putting in relevant numbers and getting a worthwhile analysis on the output. All right, so I'm going to go through some of the key project inputs. We can kind of click back and forth maybe between the screen. I'm going to pull up the model real quick. So the first one, I'll just kind of, when I, some of the things that I see um, would be related to jobs that maybe the company is giving you cumulative versus incremental numbers. So they're telling you the number of jobs that they're going to have each year instead of the number of jobs that they're going to add each year. And then we talked about this other one of retained versus new jobs. So we've tried to solve for this a little bit in Impact Dashboard just by giving you a running total. So when they start filling this out and they say, we're going to have 25 jobs, then 25 jobs, then 50 jobs, then 50 jobs, then 100 jobs, right? Like as they start to do that, they can see this 250, and they're not looking at this screen, but the input for this on the data form is similar, where it's going to give you that running total. And they can see total 250. That doesn't seem right. Then they can go back and say, oh, this is just the incremental jobs. So with the incentive applications where they're filling it out kind of in a PDF format and there's not like a running total, it's not interactive. We very often see them entering kind of those cumulative totals of jobs instead of, just tell us the incremental. And so I'm going to put this one back to the way it should be here, so to speak. Um, and that's just something to be aware of. I think a lot of times that can be one of those things that jumps off the page for folks. But again, it is something that if you just click the create scenario button, it's going to be one of those things that can throw things off. The other thing is that I've already mentioned is the retained versus new jobs created. And so we just want to make sure in Impact Dashboard, as I think everyone knows, or everyone on this call should know anyway, you have this ability to indicate the project is an expansion, in which case we'll have an input where we can identify the number of existing jobs and we separate that from the number of new jobs. So we can see in this case very clearly there's 50 existing and 100 new. Again, in some other data forms that I've seen, it's not really clear. It gets the BRE type of projects get pretty jumbled in those cases. Um, the next input, so I'm just gonna, these first couple inputs are kind of the key ones for us. Let me go back here. So we've got our jobs input. The next one for us would be this workers relocating to the area. And as everybody, again, this is probably old old news to some folks, but we'll have a default percentage built in here. This default kind of looks at commuting patterns, how likely it is for someone to live and work in the community, and what we think might be realistic to expect when there are new jobs being created. Maybe some portion of those jobs would be filled by people moving to the city. Again, it's important that this is not the percentage of ultimately people who get hired at this company that live in the city. This is critically the people that are actually moving to the city to take one of those jobs. So you might have a handful. Hopefully, we have a lot of people that already live in the city that will, fill one of these jobs. But this is for us important because we want to keep track of this kind of population impact. So again, we think of it in three different, this little question mark is helpful sometimes. We think of it in three different buckets. You've got people who already live in the city and they're going to take a job, one of these 100 jobs. You've got people who live nearby and they're going to commute in. That's fine. That's a different bucket of people. And then this third bucket of people will be those that live outside of the area, but they say, hey, they got jobs over there. I'm going to go move to that city and represent a new resident for the community. Um, I'm looking at, sorry, I'm getting distracted by the Q&A that popped up, so feel free to put those in. I'm reading it here. Are there ways to clarify in the application that we do not want total jobs per year cumulatively, but we want the added jobs per year and possibly give an example? The short answer is no, there's not a way to do that necessarily. We try to make it relatively clear. I'm going to just get distracted entirely and go over and show the data form in a second. Um, we try to make it as clear as possible. The ways at least I think that we do that are by having that live total at the bottom. So if we go to our data form here, uh, so on our jobs input, it the column says new jobs added. How many jobs will the project create? And we have this running total. So if someone were putting 100 jobs in here because they were going to hire 100 jobs in year one and they were going to maintain those. Seems a little odd that we would be including 500 total if so this is intended to try to make it clear. I think we say the additional jobs created each year, so same type of thing. The other thing that happens is when they review to try to address all of this will be the project will create 500 jobs. So we're repeating it back to them to describe like what we are taking away from what they told us. And um, you know, if if they said, "Oh, well, I didn't mean a 500," they can go back and hopefully put it together that okay, it's only 100. That's the way we wanted to enter it. So that's kind of my answer to that one. You know, if you have a again, if you have your own ED application that you're setting up in Word or PDF, you could probably phrase it, maybe differently or however you want to do exactly. Um, the going back to the workers relocating thing, I just want to encourage you to give some thought to the actual project. I think I'm trying to think about what do I see when I work with folks. I think a lot of folks don't want to change it, I guess. I see it very often that they don't change it. And in a lot of cases, you might want to change it. So for example, if the company is hiring, um, again, when we have a real project, we would know a little bit more than just, 100 jobs. We can think about the salary. So we say, how does the salary compare to the salaries for the average salary, average household income of residents in your community? And so you might say, hey, these are high paying jobs. We're going to be attracting people to the area. So maybe we would expect some people to be moving here. Um, you might also think about the specific occupation. So in the case, the examples I always give with this would be like for a warehousing project, it's going to be some material handlers. We don't, even that small 7%, we probably don't expect anybody to move for relatively, low paying jobs that could probably be filled from within the commuting distance of folks. Um, the opposite end of that spectrum would be maybe you're in an area that's somewhat more remote or rural, and the project is a new hospital, and so you can expect, we're going to need a bunch of doctors and skilled nurses. And in those cases, maybe that's a high percentage of the specific jobs, and so you want to leave the ability to kind of increase this percentage to say, hey, this is actually going to drive, some people moving here just because the types of positions that'll be hired. So that's kind of what I would say about that workers moving to the area input. The average salaries, um, the two things here are, we're asking for the average annual salaries per worker. So like $70,000 or whatever, the average worker makes. We're not asking for the total payroll and we're not asking for the hourly rate. So maybe that's what you get from a prospect. Whoops. Um, Maybe that's what we get from a prospect, but we need to, when we review it, we'll need to go in there and make some adjustments. So, let's say they put in here $30 an hour. We put that in and we see, okay, 30 direct, 25 spin up. Maybe in your head, you're still thinking like, okay, that looks good. That's $30 an hour. But for our purposes in the model, we're going to be assuming that these 100 workers get paid $30 a year. And that's not reasonable. And that's not kind of how we're going to make reasonable calculations down the line. We've added, just recently, we've added this little catch here that says the average salary seems low. Confirm that you're entering the average salary of an employee, not the hourly rate. The other end of the spectrum is when someone plugs in, total payroll, and so now we've got $300 million is the average salary, and so we've got 100 workers each making $300 million. That's going to throw things off as well. And so in that case, now we've got a flag that's catching us on the high end saying, confirm that you're putting in the average salary of an employee and not the total payroll of the company. So that's, just a couple of things to keep in mind. Again, you'll see those notifications pop up if you look at it, but you just want to be careful as you're reviewing things. Let's click through here. Oh, the other thing that, we are just asking kind of across the board the average. So we can multiply, the average salary times the number of workers, and we will end up with that total payroll. That's kind of where we're going as we think about that. If you want to capture more detail, you can use the jobs and salaries input, and that's going to be it's a data field that you can ask on the data form, but then if you're in a scenario, you can also fill it out just manually here by going into this scenario details. And it would be down here in job and salary detail. So you can say, okay, there's going to be a certain number of production workers, there's going to be a certain number of managers. We've got different salaries for those, and we can kind of get that overall, kind of weighted average salary from that information. And so this, like I say, can help you give more context to the positions that are being created, and be able to show like, hey, yeah, there are going to be some highly paid folks, there's going to be some lower paid folks, and that can be helpful for you in thinking through your project. Um, and then the other input that I want to talk about right now is the capital investment. So um, when we're modeling things, going back to our inputs here, we've got columns for land, buildings and other real property improvements, and then furniture, fixtures, and equipment. And in general, it's important for us to be able to break these out because we might want to treat them differently as they, either appreciate over time or depreciate over time. And they represent different things, in terms of real property versus business personal property, maybe. What I'm mentioning here in this idea of land value versus acquisition cost, um, we can, you have some ability to kind of decide how you want to treat the land. So for a lot of projects, if this company, let's pretend for the moment that this company is going to build a new $10 million building and invest $5 million in equipment, but this land, let's pretend that was already on the tax rolls and they just bought it from somebody, and now they're going to build their building on it. It may not be realistic to even put a value of the land here in the input. So for a lot of my projects, if we're trying to figure out just the incremental value of this project, I would leave the land as zero. Now, if there are some instances where it would realistically you would want to make sure you put the value of the land. So for example, if the city is selling the company a piece of land, and so right now, because the city owns it, it's not on the tax rolls. But when you sell it to the company, it's going to come onto the tax rolls. It really is kind of incremental land that we were going to get value on. Same thing maybe with like an annexation or something. So then maybe if it's going to be valued at $100,000 for whatever amount of land it is, we can put that in there and we'll capture the taxes on that land. So that would be one instance where you might do that. The thing that I see that comes up would be sometimes the company is going to pay a lot of money, and it's legitimate. It's part of their investment is they're paying a lot of money to buy a piece of land, but that land may not be on the tax rolls for us very much, or that same number. So it's important to kind of just give that some thought as we think about what's the value of this land from a property value standpoint versus the acquisition cost. Because they might tell you, hey, we gotta spend $5 million to buy that parcel of land, which I mean, from their perspective, is real money and it's part of the investment. But we want to, I don't know how many times I'm going to do this. Um, we want to make sure that we're only capturing things that are adding the value on the tax roll. So again, just to be clear, when we plug in 100,000 here, that's just going to pass straight through, whoops, in terms of market value as we think about the value of the property on the tax rolls. That's just passing straight through, and it's going to be in this case because this is the Texas model, 100% essentially in terms of the value of the market value to the of land on the tax rolls here, it's $100,000. So um, that's one thing just to be cautious of that we see. They're going to be telling you how much they're going to spend for purchasing that land, but it may not be what we want to capture from a tax standpoint if it really isn't going to be increasing the value of that land from the appraisal district or the assessor's point of view. Um, the other thing that comes into play here, again, this idea that they might just tell you one big number to say, hey, we're going to invest $10 million. And so you can say, well, wait, is that $10 million in a building or is it $10 million of equipment? Um, Sometimes maybe if they're leasing a building or something, maybe we can assume that that's all equipment. But it really does have an effect on our analysis as we're going to maybe assume that the building investment will appreciate over time, whereas the equipment value will depreciate over time. So it looks different than if all of this was, all of the 10 million, let's say, was for the buildings or all of this was for the equipment. In a lot of cases, we'll see a mix of those two assumptions, those extremes. But in terms of projecting out that future value, it's going to to be important there. We'll talk more about this in a second. I think I've got some slides that we're going to go into more detail on the capital investment. And that's where we're going right now. So this is kind of that series of assumptions that let us go from the inputs that you're capturing about capital investment to what that will be kind of treated as the property taxable value. So we'll just use these screenshots for the time being. So we see the capital investment in the screenshot, we're saying $50 million for a building investment, $20 million for FF&E. And we're not putting anything in for land, so we're going to disregard that. Assume that this site was already on the tax rolls. We're not gonna get any extra value out of that. So we see that $70 million investment. If we click forward, we're going to see how that comes onto the tax rolls, at least in this first stage, without making any adjustments. What do we see happening here? So in the building column, we see $50 million. Then over time, it looks like it's increasing over time. So that's kind of that idea of the real property appreciation that I was mentioning earlier. With the FF&E, they had invested 50 million, or excuse me, $20 million in FF&E, but then over time here, we see that starting out at 20, but then declining over time. This is that depreciation schedule that we mentioned. So if we kind of connect these dots here, we've got the capital investment, we've got parameters that we can adjust there around how much of that investment represents market value of the ultimate building. So we do have some ability to change that in our settings. We also can control our real property appreciation as it gets treated over time. So we see if we add these to it, and the $20 million is going to be subject to that depreciation schedule that we have locked in there. So we see what's happening to that over time. If we make some changes to it, we can see in your settings, if you go into your settings, we want to change that percent of building and improvement costs added to the local tax rolls. If we change it from the default, which had been 100%, and put it at 80%, we're going to say instead of the $50 million investment resulting in a $50 million building, we're going to assume that that is only 80%, so a $40 million building. And so this helps you kind of true up what they're telling you in terms of their expenditure and what we want to be able to calculate taxes on. The other tweak that we made in this case would be here, this appreciation. We've changed it instead of being 2%. We've said, let's keep it flat. And so it'll be 40 million for the entire analysis, in this case, 10 years. So this is, I think everybody, or hopefully a lot of folks are familiar with this idea that when you're putting in those capital investment values, you have some settings and assumptions that we can adjust that'll dictate kind of how we see that come through in our building value. The other the other side of this is the FF&E, the furniture, fixtures, and equipment. We've got that depreciation schedule, which is inside our settings area. So maybe we want to use a more specific depreciation schedule instead of the default kind of 10% depreciation to a salvage value of 20%. In this case, we're saying year one, it should be at 92%, then 86, 78, and so on. And so that's what we're seeing reflected now if we've made those changes there. Um, so if I go just to connect the dots, I think a lot of people know this, but I'm just going to kind of show it in this case. We can use those real numbers, I guess, or the real numbers that were in that preliminary that other one. So we'll put 50 million, we'll do 20 million. This is that capital investment input. Where we were looking at the resulting taxable value was over here in the detailed report. So I clicked on detailed report and then I would scroll down, in this case, just to the third table, and we can see the building value and we can see the FF&E. And so in this case, again, we had put 50 million as the input for the building. Looks like we're using 80% here. And then as it increases, that looks like 2%. So if we go to our settings, we're going to see, yep, we did change that to 80%, but we did use 2% here. So again, that's where you're connecting some of the dots here. Just in the settings, we can fine tune this. The other parameter that we were talking about was this $20 million investment in FF&E. We see it here. And if we go to our settings, that's our depreciation schedule that we're applying here. So the standard starting point for us here of 100% down 10% per year. So that just those steps there, I think, are helpful in kind of thinking about how this capital investment is connected to the taxable value, which ultimately is driving those property tax calculations as we're going to calculate the amount of tax there. I've got a couple questions in the Q&A, so I'm going to take a look at those real quick. Okay, so we have a Freeport exemption is a type of personal property tax exemption offered by some state and local jurisdictions for inventory, goods in transit that are acquired, stored, or processed within the state, but are ultimately destined for shipment outside of the state. Is there a way to capture the percentage of inventory that will not be taxed as a result, or to have the prospect factor that in? So that is a good question. We have an input. So I see this more often. So Texas is one of the few states that still taxes inventory. So I assume this is one of our Texas clients. We have an input for folks located in Texas that you'll see this. If you're not in Texas, you won't see anything about inventories. Or I say if you're in a state that doesn't collect inventory tax, you won't see this. But in Texas, we have an input called taxable inventories. So we're trying to get to the point of, what percentage of your inventories will be subject to tax. You can, so there's a couple ways to do this, but you would really just need the company to give you more details on the inventories. What I find, it's almost like one of those things where I mentioned before about if it's a legitimate input like sales taxes, they can give you the backup on that because they've already thought about this question. If a company is going to have inventories, or maybe I should say a significant amount of inventories, they may be kind of doing these calculations on their side in terms of, hey, some of this is going to qualify for Freeport exemption from the city, the county, and the school district, and so we want to make sure we know that. What you could do, the way I would do it is if we have one of those situations, is I would put in the value of the inventories, and then I would model an exemption from the portion that would be exempt. So if the city offers a Freeport exemption and 30% of their inventories are going to be exempt, we could just go in here and put that in, and we'd be able to get ultimately the value of that exemption, or how much that, I'm not going to do the whole thing here, but we'd be able to get that value as we see our inventory abatement kind of gathering here. If the county offered a Freeport as well, we'd be able to plug that in. The same thing with the school district, be able to see that. So that's how I would address the Freeport. Again, it is one of those things that I find that the prospect very often is already ahead of you in terms of being able to over explain those inventories and what percent will be Freeport and that sort of thing. So you'll very often get that good information on that. The other question here is just saying, will the recording be shared with registrants? Yes, I didn't mention that earlier, but yeah, we are should be recording and let's double check. Um, the uh, the the recording will be sent out with the email the email tomorrow for everyone. Let's go back to this. Okay, so we were trying to make that connection between capital investment, what comes up on the tax rolls, and so I think let me just make sure. Okay, so yeah, the question is here. Well, why do we know it's 80%, right? So this question of like, well, they told me it was going to be 50 million for what they were spending because that's legitimate. They told us that's what they're spending. But then the question is, well, how did we get the 80%? And that sounds like a round number that we think this building's going to be $40 million on the tax rolls. Well, that is a good point to bring up, and that's kind of where we can fine tune some of these assumptions and really need to do a little bit of research in putting this together. So we want to be able to adjust the percentage of building investment that represents market value or added to the tax rolls. And so that's that 80%. So should it be 80%? Should it be 70%? Should we have left it at 100%? And so what I'm going to suggest, or the way that we go about it when we're doing an analysis, is to benchmark your particular project based on similar properties. So if we know this is an office building, maybe we try to go find a similar Class A office building, and maybe it's a little adjustment on a square footage basis. You've got the new one that they're building is um, 20,000 square feet, but you've got one that was just built for, 30,000 square feet. Maybe you just figure out some of those things to figure out what it's going to be end up on the tax rolls for. Um, and you can look at that maybe on specific properties. The other thing that we sometimes do, we'll look kind of county-wide and just try to understand um, what's normal and how does this project, relate to what's normal. We're not saying that you necessarily need to adjust every project to be kind of the average property value per square foot for an office building in your county. That probably isn't realistic. So maybe you're in an area that's, typically has higher value properties than what the average might represent. Or maybe this is a much nicer building than typical, but we just want to be aware of maybe kind of that we're not several orders of magnitude off of what's quote normal or what exists in the county right now. So I'll show a couple examples of this. I did a project a couple weeks ago in Sherman, Texas, and it involved mixed use. And so it's a little, honestly, I'll be clear, when it's a mixed use development and maybe it's a mix of different types of retail, it's a little bit easier to go find those types of benchmark properties to be able to say, well, what is a large retail store on the tax rolls for? And so I mean, I don't live in Grayson County. I don't live near Sherman, but you can Google around and find a shopping center or several shopping centers that kind of give you a sense of okay, this is similar to what maybe my client is building. So let's drill down and try to find these property values. So it involves going out, in this case, going out to the Grayson County Appraisal District and searching for some of those properties. So, for example, I was looking for this Target. And we can see I've got a real property record and a personal property record or business personal property record. I can see those values. If I click on those, I get more detail on the specifics. And I can even come up with, when I look at, again, drilling down on the real property for Target and for the property record, it'll tell me how many square feet the target is, and I can come up with a value per square foot. And so I'll show a snapshot of some data that we pulled for that. Just this top row is the target. I've got the property ID. I mean, you don't need, like, you can, you might want to do this and make it so that you can present it or keep it nice and handy. I will tell you, I had to make this look a little bit nicer than what I initially just, uh, the table I created as like a side sheet in Excel when I was working on this. But what was important to me was I wanted to be able to track back to like what was the property ID in case I need to go look it up again. Um, how much land did this parcel include? So this was like almost 11 acres. And then what was the square footage of the improvements of that building? And so in this case, the target was about 123,000 square feet. And then what was the land value versus the improvements value? So the total value was the 9.2 million, but we can see how that broke out. Um, I was trying, we had, in my case, I was coming up with a mixed use development and it was a bunch of acres. And we just want to understand like what that was going to be in terms of the land value might be if it was going up, if it was going from um, let's say that was currently just a ag exempt land and we had, um, a certain value per acre for that. But then once something gets improved, it might be at a higher amount per acre. And so that's kind of what we're trying to keep track of there. But we're also trying to separate out this improvements from the land so that we could determine how much of this 5.4 million per 123,000 square feet. And we were coming up with our, improvement value per square foot. And so for this target, it was like $44. So, and if we think about it, if we're building a target, it's probably going to, it's almost certain to cost a lot more than $44 per square foot to build the target. But when we get to this next step of trying to understand the taxes that a target might support, we need to be able to make that adjustment. So that's where we might say, hey, it's going to be 50% of the value. It's going to cost them, $10 million to build the target, but it's going to come onto the tax rolls for 5 million, right? So that sort of thing. Um, in my case, I had all different types in my mixed use project in Sherman. We had anchors like big box retailers, and then we also had some quick service, and we had some full service dining. And so I was yeah, there were this is like just a small portion of the table. As I went through, I kind of went all around on the map. I was just clicking on all these buildings, trying to figure out what was in there, and then getting all of these different parcels that in this case they were all individual parcels that I would have to pull up. Um, I was trying to get all of those and try to get a sense of across the board, on average, what is one of these big box retailers per square foot, and what for like Chick-fil-A or for these others, what are we seeing right now for things per square foot? One of the things I'll point out, because this Chick-fil-A brings up a good one, a good point, is this idea that the improvements of 1.4 million on 4,000 square feet of improvements. Um, that's a pretty high improvement value per square foot. And it brings up the point that these aren't always assessed on either the value of the building that to construct the building that it took to construct the building. Things like these very often are based on kind of a revenue approach. So each county appraisal district will be different or assessor will be different. But things like I would imagine this Chick-fil-A, because it generates a lot of revenue, the valuation of its building is kind of more tied to the revenue. We don't really have I don't think they give you that formula necessarily, but what we can see is that, maybe the Sonic is quite a bit smaller, but Raising Cane's is in line, I guess, there. But we can see that, there are some restaurants that aren't on a per square foot basis, necessarily the same. Um, but it's giving us this, again, as we kind of get more and more properties, we can get a better sense of this, and then we can apply it to the particular analysis you might be working on. The other thing that I looked at in these cases was also kind of the business personal property. So as I mentioned, if I go back a couple slides real quick, like the Target, for example, they had a record for their real property and they also had a property record for their personal property. And so we wanted to understand not just, those improvements, but how much business personal property did that entity have on the tax rolls. And so again, trying to think of it in per square foot basis can be useful depending on where you're going with everything. And we can get a sense for some of those. And so that this is one way to kind of help, as I say, kind of fine tune or sanity check some of the things you might be working on a particular analysis. Mixed use is particularly difficult. If we were just doing an office building, we might pull a handful of office buildings in the community and feel good that we're getting kind of a good average to understand how that might relate to the one that we're working on. Um, the other the other approach that I mentioned was this idea of countywide data. And so here I've got some screenshots from a report that we did, and this is in Florida, Flagler County. We were pulling data across the entire county. So, if you're obviously your project is in one particular city, and maybe that city is a little different than other parts of the county. That, that's a fair point. But this countywide data can give us kind of a high level view of what's going on. For our purposes in this one, we were breaking things out on different types of property, so residential, commercial, industrial. Even had that tangible personal property here, so that's kind of like business personal property for the Texas folks. Um, just value, the Florida people might be getting mad at me, but this is more like market value, and then taxable value is what we're going to be applying our tax rates to. Um, for our purposes in this case, we wanted to understand residential. We wanted to kind of understand multifamily versus single family. Again, this idea of single family having one average across the entire county is a little weird. Every development or community, we don't need to say that the new development that you're working on is going to be matching the countywide average. But this is helpful just to kind of get a sense and to make you understand if your property is twice the current taxable value of the home, it can help kind of answer some of the questions for you. Same thing here as we look at multifamily, kind of as we try to figure out maybe per unit, we can see some things there. The key one, as we were able to do this in Florida, we're able to kind of break things out based on different types of commercial property and how much, again, relating this to the square footage and the taxable value and getting a sense across all of those. We did that on industrial property as well as office buildings as well. So that's again can be useful in again kind of reviewing the information that you're getting or the taxable value that you're putting in, and obviously collecting that sales tax, or excuse me, that square footage input is going to be helpful for you to be able to do some of those metrics. I'm realizing that I'm at 5 more minutes to go, but we'll keep going on. The last thing I wanted to point out was this: when you've prepared an analysis, it's helpful to go look at what are the key drivers of that impact analysis, and I guess I should be saying the key drivers of the net benefits. And so by going down here and saying, okay, total net benefits are $1 million. What are the things that ultimately are driving that number? And so if we're just looking at this screenshot, which is from a long time ago, I don't remember what the project was necessarily. But we can see sales taxes of 700,000. We can see some real property, 286, FF&E of 80. We've got utility revenue, utility costs, so this one's kind of balance out. We've got some of these utility franchise fees, miscellaneous taxes and user fees, and we've got the cost of government services. The big things, as you would expect in a lot of cases, are going to be the sales taxes and the property taxes that are driving your analysis. And that's kind of what we're seeing here. We're getting a small amount of residential property taxes. Maybe that makes sense given the project. The big thing that's jumping out to me is the sales tax. So I would want to understand, how are we getting that $700,000 of sales tax? And we can do that in the model. Again, I think a lot of folks know this, but I apologize that I don't have that actual screenshot or like that actual project in my analysis here. But if we go to our inputs here for this particular project, we can see sales taxes are 1.2 million. That seems like a big number. Maybe we click on this and try to understand, how are we getting to 1.2 million of sales taxes? As we click on that, it'll give us kind of the different components of our calculations that are driving that. So a little bit during construction here, from construction materials and worker spending and so forth. The ongoing kind of permanent workers are driving a good bit of sales tax, but we do see that that the project itself reported some taxable sales that's driving about 500,000 of that. So that might be a point where we say, hey, wait a minute, this is the manufacturer. Do they really have taxable sales? And we can go back to the data sheet, or we can go back to the inputs and we see, what did they tell us around taxable sales? And they said $1 million, and we can, take it from there in terms of whether or not we think that's realistic. I'm going to run, I had planned to do one more thing, but if you have questions, feel free to type those in right now, and I'll just kind of jump to those if we want to. But I was going to show, I had submitted a data form, and I wanted to just create a scenario and kind of work through, honestly, looking at it all the way at the end and working backwards to figure out what are the inputs that we need to really check on. So if I say create a scenario off of this without even looking at the thing, let's hope it works. So what is this going to be? I think I've got like 100 Project X projects in here, but we'll do that. Um, oh shoot, I've got a question here. Um, cool. So this thing is we're gonna put this thing in Sherman. Leave it in Grayson. Okay. Um, okay. So we can already kind of see, looks like we might have uh that cumulative issue on this. So I made this data form to kind of highlight a couple of the things that we might want to focus on. So the number of jobs added, we've got 360 jobs. Maybe we know from talking to the client that it was probably going to be around 100 jobs, maybe 80 jobs. If that's the case, they probably meant 40 jobs in year one and then 40 jobs added in year two. So we would need to adjust this, right? So as we're doing this, it's really a net of 80. Um, we can click here. This is another example where maybe they gave us the total payroll instead of whatever the actual average should be. Um, this is another piece where maybe they gave us the land acquisition cost, and that might be something we want to adjust and either disregard that. Um, and let's just jump to the results here. So we see on the results, $11 million of net benefits for a 5-year project. Sales taxes are almost all of that net benefit. Again, if we click on sales taxes, we can see we've got a ton of taxable sales that are resulting in most of that $11 million. So I would, for my purposes, I would go back to the scenario info, take a look at taxable sales. They told us $100 million. That seems questionable. So that would be one of the things on my list to go talk to them about. Um, the couple other questions here that I'm noticing. Let me try to answer some of these. Okay, cool. So the first one is about unique projects. So when it's not a Chick-fil-A or a Target, I gave myself the easy examples, right? I did not address an AI project or like an advanced manufacturer. Those are good points. So I see that a lot with AI of an AI project. On those, I've seen they put ridiculous amounts of investment in the building, which to me is a little surprising. What's not surprising is even more ridiculous amounts of FF&E, so of the equipment that they're going to be investing into the actual building. Um, the on those cases, the first thing I would do is adjust the depreciation schedule that we're going to apply to that computer equipment. So that's the first step. So I would go into the settings and we would adjust these parameters here. Um, every county is going to have like something slightly different, but if you just Google your county and depreciation schedule, you'll most likely find a document that shows different depreciation schedules for different types of property. And there's probably going to be one that's like 4-year life for computer equipment, and it's going to be something like uh, 80%, 60%, 40%, 20, and then you might just zero it out on the remainder, right? And so that's gonna basically mean that the taxable value of that investment, and let's, make it a bigger number, that FF&E is going to just depreciate very quickly. We're gonna see it go very quickly within that 5-year period. The other issue, so getting back to the maybe what the real question was here that I've still avoided, is this around an AI project on the building investment. Um, I think some of these large hyperscaler projects, um, well, there are some older data centers that you might be able to kind of go and reference. So in Texas, I'm familiar with some like in Milam County that were more like blockchain based. And so you can kind of go back and look a little bit into the history of the news articles about how much they said they were going to invest versus now what we're seeing on the tax rolls. Sometimes you can play a little bit of detective there and get a little bit better of an answer. I will say that some of the current ones that you're seeing, like I say with the hyperscaler, they're not the same as the the previous Bitcoin data centers. So it gets a little bit harder. But I think, over the next 6 months or so, maybe we'll start seeing um, some actual numbers to be able to see, maybe they're not in your community, but you might see how they get treated in a neighboring county or something like that. That could be helpful. I think um, as a starting point, if they're telling you a very large capital investment number, I would probably cut it into 50% as a starting point, and it might still be high. We looked at one. Um, it was in Texas, and we ended up putting it at 25%. So whatever they said they were building it for, which may or may not be accurate in terms of what they're actually spending, we took 25% of that as being what was going to be on the tax rolls. Uh, the one thing that I would encourage you to do is reach out to the appraisal district and ask them some of these questions about what they think or how they're going to be assessing those AI data center projects. Or again, also with advanced manufacturers, same type of thing. The big thing around kind of those high tech ones would be around FF&E. So you want to be able to get a separation between building improvements versus the FF&E, and then being able to depreciate primarily, I say FF&E, but that computer equipment essentially. Um, the other thing that I see on those projects would be that the communities are almost always just abating all of the taxes anyway, or they're giving them an exemption on the taxes. So it gets a little confusing to think about, but if you're maybe understating or trying to be conservative on the property value, and then you want to, show the amount of taxes that you're going to be exempting. Maybe you're not doing 100%, maybe you're only doing 50% or something, but just be aware that, that calculation is going to work the other way too. So if you're being conservative on the one side, but ultimately what you're going to be left with is, if it's 50%, it's 50% of whatever it ends up being. So in those cases, you might do a couple different scenarios where, um, you make different assumptions about the property value and just see how significant or how far off those two values are, whether we use maybe 25% or use 50% on these percent of building and improvements that represent market value. So maybe we set it up to 25 here, and then we see kind of how that affects our calculations. Um, Hopefully that's helpful. Those are some of the trickier ones. The other thing that comes into play, so reviewing it, I guess I would say put it at least 50%. If they're telling you a massive building investment, put it at least 50% as a starting point. Maybe do another scenario where you're at 25% or something like that. Think of it also in terms of a per square foot value. From the data center, what that would be on the tax rolls per square foot. I've seen crazy high numbers in terms of what they're spending per square foot. Um, it's hard to say if that's I mean I guess it's accurate, but it seems almost unbelievable, some of these per square foot numbers. Um, the next step would be to talk to the appraisal district and try to figure out how they're going to do it. The last thing I would say too would be ask the company what they've seen in terms of how they expect it to be um, appraised. We had a project a couple weeks ago where um, our client was coming up with numbers that were much, much higher, and it actually became a point of discussion between the economic developer and the project owner, so to speak, that they wanted to say, what assumptions are you using to do the property tax? Because we think it's only going to be valued at this. And so if they're telling you a lower number, if the data center folks are telling you that they think the property is going to be valued at a lower number, maybe use their lower number, right? So you're not always going to get transparency on like what they think that's going to work out for, but sometimes they do have numbers that they would be willing to commit to, so to speak, or share with you at least. We've done impact studies for data centers and so forth, and so sometimes we get the projections from the company themselves, and so that sometimes you can just ask, how are you getting that, and hopefully they can share some of that insight. Um, the last question that I have so far, I know we're already over time. Does the system send automatic reminders to applicants who leave their applications in progress? I've noticed we have some incomplete or unsubmitted data forms. So the short answer to that is no. We do not automatically send reminders to those folks. So if I go back to my data forms here, so this is my test account. I've got a bunch in my inbox. If I go to in progress, I can see I also have a bunch in progress. Um, my approach on this was we didn't want to uh, force you to send. We didn't want to be annoying to people that, might have started filling it out and for whatever reason didn't finish it. So we're ultimately my approach here is that we're leaving it up to you, the economic developer, to kind of follow along, so to speak. And so if you want to remind them, you can just go into your account, click on the data form inbox, click on in progress. We can see this person, it's been a month or over a month. We can click here and say share. And then we kind of pre-draft this email and we'd be able to send this to that person to say, hey, please finish filling out your data form. Um, so that would be my suggestion. The you do have the option for within your settings for your preferences to to notify yourself. So when someone starts a data form, so if you have all notifications on, you'll be notified when a data form is started or submitted. So that could be the case where, hey, I got that email the other day that said someone started a data form and now it's been 4 days and they haven't submitted it. Maybe I should log in and go, follow up with them by going into the inbox, looking at that submitted list, or excuse me, the in progress list, and then send that email. But as a matter of automatic reminders, we don't have that. It would be something you'd have to go and do yourself. Uh, that's the end of my questions that I see here. I'll wait for one more second or two if anybody has any other questions. But I appreciate everybody jumping on and staying on and hanging out here the whole time. If you have questions, general questions, feel free to send me an email. If you're working on an analysis, feel free to just give me a call or send me an email. If it's kind of a big discussion and you want to like put a time on the calendar, that's perfectly fine too. Um, but like I say, sometimes you're in the middle of it and you're just trying to find the button. And so feel free to just call if you're just trying to get a quick answer to something. But if we need to kind of really dig in on something, setting up a time on my calendar is probably the best way on that. But I don't see any more questions, so I'm going to cut it off here. Thanks again, everybody, for joining us. I'll try to get the slides and the video out here tomorrow to you in that email. Thanks again for joining us. Talk to you soon. Bye-bye.